Hello everybody and welcome to Chapter 19 on variable costing. And I have here my little friend SpongeBob SquarePants. You may be familiar with him. I know he's one of my kids' favorites. And you may be wondering, looking a little perplexed like SpongeBob here, what he has to do with our lecture today, but very shortly you will find out how SpongeBob pertains to our lecture. So our goals for today, we are at course learning objective number 10 on your syllabus, which says to compare and contrast absorption costing and variable costing. So those are two new terms that we're learning this chapter. We're going to prepare income statements using both methods and reconcile the resulting net incomes. Now, we're not going to do all of that in our video today, so don't be overwhelmed that you have to know all of that, but I do want you to be familiar with the terms absorption costing and variable costing and be able to know what's similar about them and what's different about them, because you're going to need to have that basic knowledge before coming into class, so then when we come to class, we can work on the more complex stuff, which is preparing the income statements, reconciling the resulting net incomes, and because again, this is an accounting class, not a math class, I always want us to focus on why we're doing these calculations. How are they useful to managers? So in class, I'm also going to discuss when we're going to use absorption costing and when we're going to use variable costing, because they're both useful for managers, but they're just used for different purposes. All right, so before we get into Chapter 19, I want to review some terminology that you actually have already learned that's going to come back into play this chapter. So this is terminology we learned in Chapter 14, so you're going to have to dig way back to terminology that we learned at the very first chapter at the beginning of the semester. But we're going to talk about the difference between product cost and period cost. So to refresh your memory, product costs are costs that are capitalized as inventory on the balance sheet and only go to the income statement when they are sold as cost of goods sold. So this term capitalized, by the way, is just a fancy accounting word that means to record it as an asset. So meaning these are costs that we record as an asset first, and the specific asset in this case is inventory. We record it as an asset on our balance sheet. And then when we sell the products, that's when they go to our income statement. So examples of this are things like direct materials, direct labor, and factory overhead. Right? The three elements of product costs that we've been talking about since the very beginning of the course. Okay, and these things, like we said, they go into the inventory account on the balance sheet, and then once they are sold, they move to the income statement as cost of goods sold. Period costs, on the other hand, are costs that go directly to expense on the income statement in the period that they are incurred or used, meaning they never go into the inventory account. So examples of this are selling general administrative expenses, right? We never include those in inventory, or we haven't up to this point. They just went straight to the income statement. So that's product versus period cost. Now we're going to review a terminology that hopefully we remember a little bit better because we just discussed it in the last chapter, Chapter 18, and that's fixed costs versus variable costs. So to refresh your memories again, fixed costs are costs that do not change with changes in volume or number of units. So examples of these are things like rent, depreciation, salaries. Those things will be the same monthly cost whether you make 0 units, 100 units, or 1,000 units or more, okay? Your landlord is still going to want rent whether you make 100 units or 200 units. Your landlord doesn't care, okay? So that's why we see a straight line going across here. This right here would represent 0 units. This would be like 100 or 200 or 300 or 400 or 500. It doesn't matter. It's all the same, a straight line across. Okay. Variable costs, on the other hand, are costs that change in proportion to changes in volume. So the more units you make or the more units you sell, the more of those costs you're going to have. And examples of this are things like direct materials, direct labor, sales commissions. So here what you see is a line that is sloping upwards. Okay, if you don't make anything, you're not going to have any materials or any labor. But then the more units you make, you're going to need more materials, more stuff to make your products, as well as more labor, meaning more people to make the products. So that's why those costs, if you don't make anything, you're not going to have any of those costs. But then the more you make or the more you sell, the more of those costs you're going to have. Those are variable costs. So now in Chapter 19, we're going to combine those two concepts, the concepts of product versus period cost and fixed versus variable cost, and we're going to look at those two things differently depending on which method we're using. So first, let me show you what I mean by when I say let's combine those concepts. So first, we have our inventory costs, and as we've been discussing since the beginning of the semester, inventory costs consist of three things: direct materials, direct labor, and factory overhead. Now, are each of these elements fixed or variable? Well, direct materials, as we just discussed, are variable. Okay, if I'm making t-shirts, the more t-shirts I make, the more fabric I need to make those t-shirts. Okay, so that would be variable. Direct labor. Well, that is also variable. Again, the more t-shirts I make, the more sewers I'm going to need to sew the t-shirts. Okay, so it's variable. But factory overhead is different. Okay, with factory overhead, there's so many things in factory overhead, and some of them are fixed and some of them are variable. So we have elements of both. So in variable costing, we no longer lump all of our factory overhead and look at it all together as one factory overhead amount. Instead, we divide it up between what is fixed and what is variable. So the fixed things within factory overhead are going to be things like rent, depreciation, supervisor salaries, right? The things we just talked about that are always going to be the same no matter how many units you produce. But the variable things are going to be the things that will change with the amount produced. So utilities, right? The more stuff you're making, the more you're running your machines, and therefore the more utilities expense you're going to have. Indirect materials, same thing, right? If I'm sewing stuff, one of my indirect materials might be the thread. Well, the more shirts I make, the more thread I'm going to need. Packaging also, the more products I'm making and selling, the more packaging expenses I'm going to have. So what we're doing now in Chapter 19 is we're splitting those things up into our factory overhead into what is fixed and what is variable. So let me show you exactly how we do that and how variable versus absorption costing, how those things are different. So again, we have our elements of cost. We have our direct materials, our direct labor, but now, like I said, we're going to take our overhead and split it up between what is variable and what is fixed. Okay, we're going to look at those two things separately and treat them differently. Now, under absorption costing, our product costs are going to include all of those things, right? So this is the method that we've learned in this class up to this point. Absorption costing includes direct materials, direct labor, and all factory overhead, whether it's variable or fixed. All of that, again, is a product cost, which means it is capitalized as inventory on the balance sheet first, and then once it's sold, it goes to cost of goods sold. So this is all of those things are going to go into our inventory account on the balance sheet, just as you've learned up to this point. And we call this absorption costing. As you can see, this is where our friend SpongeBob comes into play, because under absorption costing, our inventory is like a sponge, meaning it's going to soak up all of the costs it took to make that inventory. All of them, fixed and variable, okay? But variable cost, on the other hand, variable costing is different, okay? Under variable costing, your product cost, or the costs that you put into your inventory account on your balance sheet, are only the variable pieces: the direct materials, the direct labor, and the variable overhead, okay? And fixed overhead, we treat that as a period expense, meaning we're going to expense it immediately. It never goes to the inventory account. It just goes straight to the income statement as an expense. So any rent, depreciation, salaries just goes straight to expense. It never even goes into the inventory account. All right. So one of the things that will kind of illustrate this difference is computing unit product cost. So how much would we say that a product costs us under each of these methods? So here's our problem set. It says a manufacturer reports the following data for expected production of 20,000 units. So we're making 20,000 things this period. Our direct materials are $6 per unit. Our direct labor is $14 per unit. Our variable overhead is $220,000 per year, and our fixed overhead is $680,000 per year. So let's see how we would calculate product costs under each of these methods. So again, our costs are direct materials, direct labor, and factory overhead. But again, we're going to divide up what is variable overhead and what is fixed overhead. So under absorption costing, our direct materials are going to be $6. Our direct labor is going to be $14. And for variable overhead, well, they give us this, big $220,000 amount, but again, we're trying to compute the cost per unit. How much does each unit cost to make? So we have to divide this up by the number of units. So if we do that, so take the $220,000 per year divided by 20,000, it tells us that we have that costs us $11 per unit. Therefore, your variable overhead is going to be $11. And then with fixed overhead, we have to do the same thing. They gave us $680,000 per year in total, but now we have to figure out how much is it per unit. So we divide that $680,000 by 20,000, and we get $34. So our fixed overhead then is $34. Now let's look at variable costing. Okay, variable costing, we're only including the variable elements of cost as our product cost. So we have direct materials, again, of $6, direct labor of $14, and variable overhead only of $11 that goes into product costs. Fixed cost is treated totally separately. Of $680,000 of fixed overhead costs, that goes straight to the income statement as a period expense. So if you're going to look at the total cost per unit under absorption costing, it comes out to $64, which is all of the elements, so $64 per unit to make that product. But under variable costing, our inventory cost per unit is going to be only $31 because it doesn't include any of the fixed overhead. That is all expensed. So what these two different methods are going to do is they're going to create differences in both net income because your period expenses are going to be expensed immediately versus under absorption costing, they're included in inventory and only expensed when they're sold. And this is also going to impact our inventory account as well because any unsold inventory is going to be $64 per unit under absorption costing, but only $31 per unit under variable costing. So these two methods have different looking income statements. The absorption costing income statement is going to look like a GAAP income statement. Okay, so sales minus cost of goods sold equals gross margin minus your selling general administrative expenses equals operating income. So this is the same income statement that you guys learned back in 1A, and it's GAAP and it's used for financial reporting. But a variable costing income statement is going to look different. It's going to look like the contribution margin income statement that we learned in Chapter 18, right? Which is the sales minus variable expenses minus contribution margin minus fixed expenses equals operating income. And really what we're doing, again, is just rearranging the expenses, okay? Taking our cost of goods sold and splitting it up between what is variable and what is fixed, and our selling general administrative dividing those up between what is variable and fixed. And that is not used for GAAP. Instead, it's used for managerial purposes because managers don't have to follow GAAP. They just have to do whatever makes sense for them and will help their business.